Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 7th of March. I'm Daniel Lam, your host for the podcast. Well, over the last few days, my ego had been 150% deflated. I watched a video which showed the current world chess champion, Magnus Carlsen, being able to quote the players, the year the game was played, and how the game went, in all the different positions that were shown to him. And people have been saying that I have a great memory. Not so after I saw this. Well, fortunately in finance, you don't need such colossal memory in order to figure out your bearings. For example, the upcoming US non-farm payroll. How may that look like, and how you should be positioned ahead of it? Well, currently the expectations for Friday's payroll release is hovering around 200,000. But there could be upside to this number on the back of the strong set of US macro numbers over the last few weeks, plus last Friday's services ISM print. The stability in the headline figure suggests that aggregate payrolls, i.e. the combination of jobs, hour, and wages, may actually repeat January 2023 strength. Moreover, if you look at the February credit card data in the US, the spending on hospitality and leisure services last month came in higher versus January's, suggesting potential upside from these parts of the labor market. Now, this is important for top-line payroll release, since these sectors account for 1/3 of new jobs over the past few months. Now, does that mean significant upside for US 10-year yield from here? Perhaps not, because the market implied December Fed fund rate for 2023 is now almost exactly in line with the average of Fed members' Taylor's rule prescription. So unless the US inflation figure comes in materially higher, yields are probably likely to range bound here. At 4% to 4.2%, there is strong technical resistance in the US 10-year yield. We continue to expect a US economic recession as a result of the Fed policy tightening. This, in turn, is likely to eventually cap bond yields as the tug of war between higher policy rates and prospects of slower growth are ultimately dominated by the latter. We continue to expect yields to move lower over the year. This suggests extending average maturities in bond portfolio, especially in the higher quality bonds. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.